business back to something better than -5. But so a couple of things. One, I'm incredibly proud of the leadership team and the strong execution that we've delivered. We have the right strategy and we're focused on it. And it's a foundation of just healthcare engagement. It's one of the things we really believe. So we have over 9,000 community pharmacy destinations where we know we can service patients and members in a much better way to create differentiated services. At this point, I'm proud to say we are the best run pharmacy in the country, and it's operating nationally at scale. It has extremely strong consumer engagement and really good clinical expertise that we're delivering into the marketplace. And it's a very, very strong deliverer of trust for our consumers that we can then continue to create value in other parts of our enterprise. When you think about what's driving that, first, from a business perspective, we were very deliberate in our investments in technology and taking care of our colleagues. We have over 200,000 colleagues in 9,000 of these stores that continue to deliver best-in-class service. And then secondly, we were focused on how we can engage and better engage consumers in a differentiated way. So all in all, it's going really well. As it relates to the quarter, we delivered a strong quarter despite some of the persistent reimbursement pressures that we faced. If you look at the script growth, we had top line growth about 11.7%, and our pharmacy market share is now at 28.9%. Rite Aid was one of the drivers that was in that as we kind of moved that business into our operating model. But just remember, the strong foundation, the strong service enabled us to really be able to do that in a much more effective way. And then if you think about the immunization piece, we continue to be a trusted choice and a convenient option for those choosing to get vaccinated. The market demand is down year over year, but we've been able to offset that with a market share growth in our channel. We've seen approximately 400 basis points of market share growth inside of CVS. Secondly, if you think about our front store, we still have strong momentum. We're posting another positive comp for the second quarter in a row and improved from last year. We grew our customer base 2.6% versus last year. We increased trips 2.7% versus last year. And our retail market share on the front store has gained by 2 basis points versus last year. So we're continuing to focus on delivering the value, being where consumers want us to be in the front store by driving loyalty and improving our value proposition. And, I just say, all in all, we're incredibly proud of the results, incredibly proud of the leadership team and the focus that we have here, but we still have more work to do to stabilize this business over time. And Brian, I'll hand it over to you for a couple more comments.
Yeah, no, just in terms of the outlook, the strong performance Prem talked about in the quarter, we lifted our guide for the segment, and it's now sitting at a growth of 3% for the year. And I'd remind you that's an 8% swing from our initial expectations of down 5%. So we're seeing that business improve, and we'll talk more about it come December 9th at Investor Day.
Yeah, maybe just closing out on the PCW conversation. This is a business that we've been investing in for the last several years. I think some of this is coming to fruition in terms of the investments we've made in becoming best in class. So we've talked about this in the opening comments that the 9,000 stores is our front door to the enterprise. And when this business runs well, it does become the force multiplier to improving health and our focus on serving the community. So really excited about the performance, and we'll share obviously more, as Brian said, on Investor Day about the future direction of this business.
Our next question comes from Stephen Baxter with Wells Fargo. You may now unmute your audio and ask your question. Stephen Baxter, you may now unmute your audio and ask your question. We'll take our next question from Elizabeth Anderson with Evercore. Please unmute your line and ask your question.
Good morning, guys. Thanks so much for the question. Hopefully you can hear me. I had a question in terms of the 100 basis points of provider liabilities that you called out. Can you give us a little bit more detail on exactly what those are? And is this a one-time item? Do we expect this to continue for a couple of quarters? Just any additional color there would be helpful, because obviously with that, it shows that your MBR was much more in line than maybe it looked like from the first glance. Thanks.
Yeah, Elizabeth, thanks for the question. And you're correct in that assumption. So Brian, we want to speak to the.
Yeah, the I guess I'd lift it up that from an HCB perspective, Elizabeth. We're really pleased with the performance in the third quarter. As you think specifically about the third quarter MBR, some of the noise I called out in my prepared remarks, we had about 100 basis points of impact. Two things: provider liabilities. Those are from dating as far back as 2018 for kind of a 3-4 year period, and then a combination of that was roughly 50 basis points of the 100, and then worsening expectations for the individual exchange risk adjustment. We got the latest Wakely data that informed that. So those two factors really took a 92.8 as we printed, and if you back that up to get to a 91.8 roughly, it would say that the core outperformance on the MBR in the quarter was driven on an adjusted basis by individual MA. So that's how we think about the two drivers specifically to your question.
We'll now take our question from Stephen Baxter with Wells Fargo. Stephen, if you're calling in today, please use *6 to unmute.
Hi, Hi, thanks. Sorry for the difficulties there. Just to kind of come back to that point a little bit, I think with the first couple quarters of the year, you sized in each quarter that I guess on a continuing basis there was around $500 million core upside that you weren't taking through into the guidance. Wondering if there's an equivalent amount if we think about kind of excluding the items that you called out around the exchanges and around the out of period settlements that you cite for Q3, and I guess how do we reconcile that versus the raise that you made? And I guess just one clarification as we're getting a lot of questions on it. This mid-teens EPS growth that you're framing for 2026, is that after taking the 45 cents out of the baseline, or is that off of this year's guidance as you currently revised it? Thank you.
Yeah, to take your last question first, Stephen, you take the midpoint of the guide, which is 660, back off the 45 cents, and then you can grow mid-teens off of that. And the way we got to the 45 cents, I think going into the quarter, we had about a combination of net both positives and negatives. If you take some of the out of period risk adjustments and revenue adjustments, net of the upside, we'd be about $900 million coming out of the first half of the year. You take the 150 of the provider settlements, that's how we get the 750 roughly, or the 45 cents as we adjusted, which I just walked you through.
Our next question comes from Michael Cherny with Leerink Partners. Please unmute your audio and ask your question.
Great. Thank you so much for taking the question. I know Lisa had asked about the PBM headwinds that you had been discussing. I want to talk a little bit more about the PBM tailwinds. Beyond Cordavis, what are you seeing broadly from a specialty growth perspective? And can you talk about some of the strategic advancements you're making to continue to benefit from what has obviously been a extremely strong overall market growth? Thank you.
Prem, you want to take that?
Sure. Thanks for the question, Michael. Just a couple things. So from a tailwind perspective, as we've said, we see a tremendous opportunity to continue to lower costs for our customers. And as you know, when we can lower costs for our customers, the PBM industry typically benefits from that as well. So a couple things. One is, if you think about the biosimilar pipeline, it still remains. There's $100 billion of biosimilars going biosimilar by the end of this decade or early 2030, 2031 timeframe. So we continue to look at ways in which we can enable and drive down costs for our customers as it relates to biosimilars. We believe that there still is our ability to benefit from other specialty drugs as well in the generic pipeline that are going biosimilar or that are going generic. That will be an opportunity for us to deliver value for our customers. And let me just take a couple seconds to talk about our CVS specialty pharmacy business. It continues to be a leading asset in the specialty pharmacy arena. It's a leader and a key overall performance driver of Caremark, and we expect it will continue to be helping to support the members that they serve. Remember, these 1 or 2% of the population that utilize specialty pharmacy benefits typically drive 50-60% of all of healthcare expenditure. And so our business continues to perform really well, and we have a strong track record of continuing to gain access of new limited distribution drugs in that space. We continue to build technology that makes it seamless to transition patients from branded products to biosimilars. And lastly, our operating platforms, tremendous amount of credit goes to our leadership in this business, is driving to a much more tech-driven AI native platform that's driving and really taking a lot of the work out of a lot of operations and something that was one of the most complex parts of healthcare, which is effectively trying to drive these medications into the patient's homes. And so we continue to be really proud of those points as it relates to that. We also see opportunities in the PBM for, what I would say is efficiencies and optimization over time, where we see the opportunity to leverage technology and other things to also play a role. And lastly, I think, the PBM sales season is great evidence that we continue to focus on our customers. We're winning net new customers and delivering the value that they're asking for us. We had over $6 billion of net new sales for 2026. So continue to be excited about this industry. It remains to be highly competitive as it always has been. And we continue to remain to be a leader in driving that competition and driving affordability for our customers and creating innovative solutions that they can deliver into the marketplace. So,
yeah, thanks, Prem. Maybe just one additional comment on the PBM, because there's obviously emerging models that we're seeing around the DTC. So two things I would point out. One is we were the first large provider to join the NovoCare program for GLP-1s. So that's, again, our push into lowering the cost of these obesity products in the direct-to-consumer market. And then the most recent announcement we made with the administration with respect to the IVF therapy, again, our specialty pharmacy playing an essential or critical role in the rollout of that program as we serve consumers and our customers.
Our next question comes from Eric Percher with Nephron Research. You may now unmute your audio and ask your question.
Thank you. I'd like to return to Caremark and ask you to clarify the extent to which you're seeing pressure from adoption of true cost versus change in mix. If it's true cost, how much of that was CVS? I'd expect you were ahead of that versus others or independents that you're enabling. And then if more change in mix, are you seeing that changes to GLP-1 formulary or biosimilar private label is having an impact on rebate guarantees?
Yeah, Eric, thanks for the question. First off, let me be clear. This is not from true cost. The true cost model is not what's driving this. As you know, in the legacy PBM models in the PBM marketplace, we predict and try to drive rebate guarantees, which is a way in which we derive the value for our customers. In that case, we had probably three primary drivers of some of the pressure. One, the slower growth of GLP-1s that we're seeing in the back half, primarily driven from we expected a little bit more of the compounding volumes to come back into the benefit, which we're not seeing. Secondly, we had a couple products on the autoimmune category, not related to Cordavis, but drivers of a couple products that were driving that. So one is in the autoimmune category and one is in the HIV category. So this is not from true cost. It is something we're working with our clients, actively adjusting our guarantees appropriately as we move forward, but create a little bit of pressure in the short term.
Our next question comes from Andrew Mok with Barclays. You may now unmute your audio and ask your question.
Hi, good morning. Wanted to ask about the recontracting efforts at Oak Street and understand the room for improvement there. So first, can you share the pre-tax operating losses of that business today? And to the extent you had problematic external membership this year, did you see the needed changes made to benefits for the 2026 plan year? And if not, can you help us understand what contracting changes you're making, including how much risk is shifting back to your Medicare Advantage partners? Thanks.
Thanks very much. I'll let Prem talk to the business and the evolution. We don't share the pre-tax loss, but I think we've been very focused on the Oak Street business. Once again, the impairment we took was at the HCD level, but we took a look at clinic growth and really by slowing the clinic growth, the terminal value is what drove the impairment charge. And we believe we're getting the Oak Street business in particular on the path to profitability. Prem, you want to give a little color on the business?
Yeah, sure. Thanks for the question. First off, just to be really clear, the performance in this quarter was in line with our expectations that we kind of, as we adjusted guidance from prior. So performance is in line. If you think about value-based care, and David mentioned this in the prepared remarks, it's still a critical component of our strategy. We recognize the significant impact it can have on the healthcare system, the importance to patients on experience and outcomes and cost. So there's 3 or 4 things that we're really focused on in Oak Street Health. Let me just talk specifically to the payer contracts. One, we won't comment on any specific contracts, but we're focused on ensuring that we have alignment with our payers on ensuring the sustainability of these agreements and, having fair and equitable terms for the value that we provide. So we're continuing to work on that with our payers and continue to, drive that forward. But the 2 other areas I think that are really critical is, we are really proud of our clinical model that we have. We continue to, enhance our technology and our operations to drive and enhance a model in which will ultimately lower costs and improve quality of our members. And lastly, on the center footprint, listen, at the end of the day, the world has changed in value-based care, so we're being very prudent, and we've slowed the number of clinic growth that we had, and we're focused on growing membership inside of our clinics. And so from our perspective, those things are all the components that are driving, and we expect the Oak Street business to improve year over year. And lastly, as it relates to V28, it's in line with our expectations of the impact of that as we think about that business.
Our next question comes from George Hill with Deutsche Bank. You may now unmute your audio and ask your question.
Yeah, good morning, guys, and thanks for taking the question. And David and Brian, my question's kind of focused on the retail pharmacy business, and you talked about how 2026 is going to show an improvement from the long-term guide. I guess I would ask if you can comment, how far are we away from like the long-term guide of down 5 not being the case anymore? And given that PBMs are paying pharmacies more money and cost advantage is taking root across different payer segments, that earnings growth starts to look more like script growth in that segment. I'll stop there.
Yeah, when we, thanks George for the question. Maybe high level, when we announced cost advantage, that was the long-term goal, which we are the largest purchaser in the country today. We believe we have the best cost of goods in the market. And as we perform better, the payers will get the benefit of that. And so that is, we are now going into year 2 of that in 26. So as we get to Investor Day, we'll have more clarity about how that business will be performing. But ultimately, we do see better alignment with the payers in terms of how the actual cost of goods align with the actual reimbursement for the services we're providing. And so, Prem, you want to give any other color?
Yeah. So, George, remember, there's 3 primary headwinds in the retail business. If you go back when we started cost advantage, 3 tailwinds that were offsetting one big headwind, which was reimbursement pressure. So the 3 tailwinds were, we would always drive incremental volume into our stores, right? Script growth. We would, have productivity initiatives that drove and lowered the cost of our cost basis of delivering those scripts. And lastly, there was cost of goods improvement, and all that netted out to a somewhat tailwind or a headwind that we were trying to cover. If you think about what cost advantage was doing, and as we mentioned, it was going to take a multi-year journey to get us to a place in which reimbursement erosion equaled our cost of goods improvement. We're making good progress toward that, but we still have reimbursement pressure in the underlying business that we continue to focus on. So just from a cost advantage perspective, as we said at the beginning, 2025 was a transition year. We're proud that we moved all of our commercial and third-party discount card programs into our cost advantage program. We're making good progress in Medicare on transitioning to cost-based pricing models across our full book of business. We're more than 60% complete and targeting 100% of our eligible book by the start of 2026. If you compare our Medicare negotiations to our commercial negotiations, we're ahead of where we were last year. So we feel pretty good about where we are. And lastly, if you think about the impact of cost advantage, at this point, it's performing in line with our expectations. As I said, it's going to be a multi-year journey to get that back. And we're addressing one of the major pain points that existed in retail pharmacy, which was cross-subsidization of branded and generic drugs.
Yeah, and George, maybe one final comment. Your thesis is right, which is our growth should be tied to script growth. And as we get cost advantage rolled out across our payers, that will become part of the growth. The second part is the services we're going to provide inside the pharmacy. So if you look at the STARS performance within Aetna, a lot of this was driven because of the collective enterprise effort and the services and the specific programs that have been delivered and launched within retail to engage and drive better performance around adherence and the other quality measures. So that is the next frontier, and this is how we're going to collectively drive the value across the enterprise.
Our next question comes from Kevin Caliendo with UBS. You may now unmute your audio and ask your question.
Thanks for taking my question. I want to ask a little bit about what's embedded in your 26 comments for the healthcare benefits around MA margin expansion. Can you get to be profitable next year? And also enrollment. I know enrollment's not over yet, but your sense of where your enrollment goes in individual MA next year.
Thanks for the question. As we think about the guide, which we'll really get into in December at Investor Day, but in HCB, which you asked about, I would say we expect another year of meaningful margin improvement. It'll include progress in MA. I think that reflects our disciplined approach to the plan design and footprint. We have repricing opportunities in group with, I think, about half the book repricing as of January. As you think more broadly about HCB, we'd expect a tailwind from our exit of the IFP business next year. And while we're seeing good progress in Medicaid in terms of rate advocacy discussions, we are taking a cautious outlook in light of the broader pressures that are across the industry. Steve, you want to provide a little bit more color?
Sure, thanks. Good morning. Look, when we entered this year from the Aetna perspective and all of CVS together, we're focused on a couple objectives. One is to return the business to target margins. Second, to regain leadership position overall in the industry. And within those objectives, we rallied around three very specific priorities: to be exceptional to fundamentals, make sure that we were distinctive and we could offer distinct capabilities to our customers, and build a really strong culture with top talent. And so we've been executing with discipline and rigor and urgency around those three priorities. And as you can see by the performance, and as Brian highlighted and David in his opening remarks, the plan is working. And so we are really encouraged by the progress across all of our businesses at Aetna. And we believe this momentum will carry into not only the fourth quarter, but 2026. So we're going to lean into that momentum. Having said that, we're obviously respectful of the high trend environment, and it's a first year of a multi-year recovery. So really encouraged by the progress. And maybe I'll just a couple comments on Medicare and open enrollment as you ask. Look, obviously early days, but it's going according to our expectations, in line with those objectives of returning and continuing on the path to returning to target margins on this business. We made really great progress. Actually does a little bit ahead in terms of favorability, in terms of trends in the individual Medicare Advantage business in the third quarter. And so we're going to take that momentum, and the early signs in AEP is that we're on track to continue that momentum and keep the business on track to returning to target margin. With respect to just overall competitive positioning, we like our position. Again, early days. We do have the ability, and we've developed capabilities as we did last year during AEP to continue to make adjustments and be nimble as we need to dial up and down products, geographies, other kinds of mechanisms that we have to make sure that we continue on track in a really disciplined and rational approach. So far so good. And I would just say we expect to exit AEP roughly flat in our individual Medicare Advantage membership. So very encouraged so far, early signs. Look forward to providing more color at our Investor Day.
Yeah, Steve, great quarter, and congrats to you and your team. So this will conclude the earnings call for this quarter. So before I end the call, I just want to thank our dedicated colleagues across CVS Health for the work you do every day. The trust we earn comes directly from the commitment to caring for our customers. I'm very encouraged about the progress we continue to make and look forward to providing you additional updates at our Investor Day on December 9th. Thank you for joining the call.
Thank you for joining CVS Health's third quarter 2025 earnings call. This concludes today's conference call. You may now disconnect.